fashionably diverse one-off deals. I'll give you an example. So a family wishes to buy price protection 20 years out against increases in Yale tuition costs. And that sounds far-fetched, but that's the sort of thing that Enron was doing, not with Yale tuition costs, but taking very exotic situations and then pricing them. So I sort of took an example, 40, 50, 60, 70,000 a year, years out, and I'm sure we'd all have a point of view as to how Yale's tuition is going to go up. I mean, if it continues constant, it goes up probably about inflation plus 2 or 3% a year. You'd have a curve, but it would be very judgmental. There'd be some plausibility to it, but who knows? And no one else is making a market in this. So if you're Enron and you've staked a huge amount of money, for example, on this one trade, how do they decide how much money they've made in a given year? Well, the answer is they use their own curves. And if they want to make more money, they just change the assumptions. And who's to say they're wrong? No one. And that was what was happening. So you have one-off assets, risk positions, which were nearly impossible to value, where the ability to recognize income could be affected with the stroke of a pen. And if you're able to recognize income pretty much any way you want, perversely, your view of the risk of that type of asset, it'll slowly start creeping into your mind that it's a low-risk asset, because it always has this wonderful profitability that never seems to go down, never problematic. Now, normally you'd expect external auditors to question these assumptions, but Arthur Andersen was making $50 million a year off of Enron. Are they going to question anything? No. So they could basically create income anytime they want. The problem, though, is you end up having an increasing divergence between the income you're creating and cash, real cash flow, and you're having increasing divergence between what I might call the intrinsic risk of an asset category and the risk that you perceive based upon your own manipulative control over recognition of profits. And that becomes the source of Enron's own downfall, is that they, right at the start of each transaction, they were manipulating the numbers. It wasn't a top-down type of adjustment like WorldCom, where basically all the people at the subsidiary level were doing honest things, and then right at the top they started monkeying with the results. At Enron, every single transaction was gamed to figure out how it could create income, maximize income, short-term income. But once you start doing that, it starts becoming harder and harder and harder to figure out, well, where should I be investing my money? Where should I be placing how should I be adjusting my risk portfolio? How much debt should I take on? Because no one has any idea what the risk is, and no one has any idea what the profitability is. And that sounds crazy. That's what itself. I can create an alter ego, something that looks a little bit like an independent company but isn't. I can recognize gain on the sale, even though I'm really selling it to myself. And that's because the loopholes in the accounting allow you to achieve form over substance. To break the code, though, you have to have a complacent auditor. And in the case of Arthur Andersen, over half of their services weren't even auditing services. They were consulting services. In other words, if you want to make a lot of money in a short period of time, you take a firm that has existing good reputation, and then you use that reputation to be able to generate high profits in the short term. The way you do that is you say, Arthur Andersen, well, a high-quality firm, so I don't have to worry about funny stuff in the accounting. I don't have to worry if I'm a reader of those financial statements, an investor. I don't have to worry about whether they're basically disguising debt or whether they're basically creating their own earnings out of thin air, because Arthur Andersen is a high-quality firm. So generations of people could have built up the reputation of a firm, but maintaining a reputation, like maintaining a building, requires a lot of ongoing investment. And if you really want to get a lot of cash flow in a short period of time, Well, you just let it start to disintegrate, but people won't notice what's really going on for a long period of time. And while you're fooling them, you, if you're Arthur Andersen, Enron, one of their clients, can make a lot of money, because this is easy money. This is easy, because basically you don't have to create value.
American capitalism in a state of advanced moral and ethical decay, or?
Not necessarily. If people can grasp the requirements, the need for ethics just to keep the system going. If people don't come to grips with that, I think it's just going to get worse and worse.
Okay, there's a big point there. Think now back to Smith's invisible hand, and to Hayek and the creative powers of a free society. All of that thinking has built into it at the very most basic level an assumption about truth-telling and access to broadly correct information. And every single tenet of the tradition which runs from Adam Smith through modern economics is founded on that. And for Smith, the ethical side of it was explicit with the theory of moral sentiments. The way economics is taught and the way business management is taught, the emphasis on an ethical commitment to truth has been somewhat submerged. It doesn't have the central status for us intellectually that it did for Smith's generation. I think that's a fair statement. But Jim, this has been, as it always is, very illuminating and even inspiring. Thank you very much.